Hello, hope everyone is cool. So today we are going to talk about directional bias as promised for this February. And based on direction bias, there are key things which we have to understand, right? So the first thing, once you talk about bias, you are dealing directly with the direction of the market, right? So dealing with the direction of the market, you must understand that this move, it is overall, we are dealing with the overall direction of the market, or it is just the short-term move of the market based on its bias. So to extract that information in the market, there are key basic things you have to understand ba- by consideration on the bias. The first thing you have to consider the bias by consideration of the time frame, right? But another thing, you have to consider the bias with the consideration of the structure. So that's why once we talk about directional bias, there's a key difference. Once you must understand that in which approach you are talking about. You are talking about the directional bias based on the time frame, or you're talking about the directional bias based on the structure. So you have to understand that. So today we'll start up with time frame. So start up with time frame. We have types of time frame based on the bias. We have the constant time frame and we have the situational time frame. So the constant time frame, these are the time frames which give us the overall direction of the market, right? So these are the time frames which we consider them as the parents time frame. They give the direction to the lower time frames, which we consider them as the children time frames, right? So it is just like parents, or it is just like the family. The parents are give the direction to the children are following the direction of the parents. So that's the way it is. So we consider the constant time frame at the parents, and we consider the situation time frame at the children. So the constant time frame, they give the direction to the situation time frame, where therefore the situation time frame follow the direction of the constant time frame, right? So once we talk about the types of time frame, it is that way. But on the groups of time frame, based on the types of time frame, we have two groups. We have the groups which are working together. So the constant time frame, some of constant time frame, they are coordinated to some of situation time frame, and they are aligning together and work together, right? So that means the way we used to approach the market by performing the top-down analysis by starting from the monthly, then weekly, then daily, then for hour, that was not correct because we are trying to create something which is not usually aligning to each other, right? So the logic behind that is actually is not okay because the bias is not aligning to each other. So what you have to understand is that there's the specific coordination of the time frames according to their types of time frame, right? So which they work together. The first group, for example, the first group we have monthly time frame as our constant time frame, right? So once the monthly time frame become our constant time frame, then we consider the daily time frame as our situation time frame, right? So, and also once we consider daily as our constant time frame, then we consider 1 hour as our situation time frame. And then once we consider 1 hour as our constant time frame, then we consider 15 minutes as our situation time frame, right? So, and also once we deal with 15 minutes as our constant time frame, then we deal with the 3 minutes as the situation time frame, all right? So that means in the area of the constant time frame, we can make decision on the area of the constant time frame by the consideration of the situation time frame, all right? So we cannot make decision on the monthly time frame directly with the consideration of the weekly time frame, right? Because it is not its situation time frame, right? So it is just like that. So the second group, the weekly time frame, once it is a constant time frame, then we consider the 4 hour as our situation time frame. Then once the 4 hour is the constant time frame, then we consider the 30 minutes as our situation time frame. Then once 30 minutes is the constant time frame, then we consider 5 minutes as our situation time frame. So between these two groups, we have a specific time frame which you consider it as this universal time frame, which can be used in these both groups, which it is the 1 minute time frame, right? So the 1 minute time frame can be used in both groups. The second group in the uh, first group, because once the 3 minutes become our constant, then we can consider 1 minute as a situation, and once 5 minutes become our constant, then we can consider 1 minute as our situation time frame. That's why you consider the 1 minute as our universal time frame, right? So basing on that, uh, for these criteria on the lower time frames, by consideration of the lower time frames, including the universal time frame, to to its constant term from specific constant from whatever the group, whether it is the first group or the second group, you must understand that in which way you are going to make decision, because you have to make decision on the constant time frame within the constant time frame, and your direction must align to higher time frames, right? So it is just like that. So let's go together to the sum of structure theoretical examples. Okay, for example, let's take a look at this one, the first group. So once we say that our monthly time frame become our constant time frame, then we consider something like this. Because we have already talked about how to identify areas of liquidity on the first concepts. So once we consider this is our monthly area of liquidity, right? So this is our monthly area of liquidity, let's assume that the market was already able to come and react to this area, firstly, in order to understand this key concept. So for that reason, what is going to happen, and once you find out that sometimes the market provide for you a clean area of liquidity which was not yet, the liquidity was not yet grabbed, or it is not yet liquidated, right? So how are you going to make decision? So once the market come within this area of liquidity, which is the monthly area of liquidity, which we can consider as this one. So this is the high, right? The monthly high, and this is the higher low. And also here we can consider as the monthly high, and this is the monthly higher low. So that means this is the monthly area of liquidity. So once the market came within this monthly area of liquidity as a constant time frame, then we can check out our situation time frame, which is daily, which within our daily time frame, you will find something like this, right? Market was able to create the series of high and higher lows and lower highs and lower lows, because on the constant time frame, we'll see that those structures or those areas of liquidity which were found on the situation time frame, they are not reflected on the constant time frame. They are hidden. All right. So in order for us to extract the information from the situation time frame, we have to go to the situation time frame. And in order for us to be able to make the clean decision based on the situation time frame, we have to make the decision on the situation time frame once the price, or once the market is within the area of the constant time frame. So that means we are within the area of the constant time frame, which is the monthly time frame. All right. So the market was able to give us the clean market shift. All right. So the market was able to give us the clean market shift, and able to give us the clean new formation for the market to grab the new liquidity and proceed with the move. So after the market be able to perform a shift on the daily, which is the situation time frame of the monthly, then we expect the market to come back and liquidate that daily area of liquidity or daily formation. So that means in order for the market to again to liquidate the daily formation, so that means we change from the monthly to consider the monthly as our constant, we consider the daily as our constant time frame. So that means we will wait for our situation time frame to change direction or to perform a shift in order to come to liquidate that daily formation. So after the market become able to perform a shift on the 1 hour, then the market come within the daily. Once it reach to the daily and be able to liquidate that area, then we'll wait for the shift on the 1 hour. All right. So once the market become able to perform a shift on the 1 hour, it is just like this. So this was the 1 hour shift, and we have the formation. So after the market become able to perform a shift on the 1 hour and left us another formation, then we cannot consider daily as our constant time frame again. Then we'll consider 1 hour as our constant time frame because the market was already able to perform a shift and left for us the formation. So that means we'll wait to see the reaction of the market within that formation of our 1 hour as our constant time frame with the consideration of its situation time frame, which is the 15 minutes. So we'll wait to see the reaction of the market within that area on the 15 minutes as its situation time frame. So after the market become again to perform a shift within that area, which is the 15 minutes shift as the situation time frame of the 1 hour. So we'll wait again to see, we'll consider 15 minutes as our constant time frame and we'll wait to see the market liquidate again that formation by consideration of its situation time frame, which is the 3 minutes, and perform a shift. Then, so from there, we can again confirm the liquidation of the 3 minutes formation with the 1 minute shift as our universal time frame, which we'll consider it as the situation time frame because we'll consider the 3 minutes as our constant time frame. So from there, what is the meaning of this? The meaning of this is that from this criteria, it shows that you were about to look for the opportunity within the monthly time frame as our constant time frame. So if you take a trade here and you're expecting for the market to go into form this high, all right here. So you want to take this trade here. So if you take a trade by consideration all of the daily time frame, so that means that criteria is not enough because the daily time frame can be bullish. The buyers of the daily can be bullish, but the buyers of the 1 hour can be bearish, right? And the buyers of the 1 hour can be bullish, but the buyers of the 15 minutes still can be bearish. So if it is still bearish, then that means there's no possibility for the market to proceed to form that monthly high. There's the possibility for the market to grab liquidity to the bearish type area of liquidities, right? To the bearish type area of liquidities, and then proceed with the bearish move, right? So you have to make sure all time frames are aligned together, right? So if we are about to we're about to look for the possibility for the market to form the new high, we have to see the buyers are aligned to each other on each time frame. So that's one of the key thing to consider. So let's go to the second group. It is similar scenario. It is similar scenario. So once we consider the second group, the weekly as our constant time frame, then we can consider 4 hours as situation time frame. So once the market come within this weekly as our constant time frame within this area of liquidity, then we can wait for the market to give us the clean shift. All right. So after the market give us the clean shift within this weekly area of liquidity as our constant time frame, then we can wait for the market to give us this shift on the weekly as our situation time frame on the 4 hour. So after the market give us the 4 hour shift as a situation of the weekly, then we can wait again for the confirmation of this shift by consideration of the shift on the 30 minutes. So after the market give us another shift on the 30 minutes here within the 4 hour time frame, then we can wait for the shift on the 30 minutes time frame. So after the market give us another shift on the 30 minutes, which is the situation time frame of the 4 hour time frame, then we can wait because we are going to consider the 30 minutes as our constant time frame. So we can wait for the shift on the 5 minutes here. So the shift on the 5 minutes will be considered as the situation time frame shift or the 30 minutes. So after the 30 minutes shift happening in situation time frame, then we can confirm that shift by considering that we have already this as our constant time frame. Then we can confirm that shift by consideration of its situation time frame shift, which is the 1 minute shift, which we consider it as the universal situation time frame. So we'll consider the 5 minutes as a constant time frame, then we'll consider the 1 minute as a situational time frame. So after that, that means we are bullish on the 4 hour, we are bullish on the 30 minutes, and then we are bullish on the 5 minutes, but also on the 1 minute. So that means we are able to form the weekly high. So it is just like that. So that's how we are supposed to take a look or to confirm our bias.